Good evening, traders. Welcome to a new weekend educational trading video here on the channel. So today I want to revisit a concept that might seem pretty basic and aim more towards beginner traders, but I'm going to be making a series in the next few weeks on market structure, and I'm going to specifically talk about different price action and market structure trade entries, both bullish and bearish scenarios, with signals of how you can take trade entries and decisions purely based on price action without having to use any type of indicators or anything. Sort of going back a little bit to basics, I want to revisit some of the concepts that I talked in the first videos that I made here on the channel before I started getting a little bit bigger audience. So if you haven't done so, make sure to subscribe so you don't miss out on any content coming up in this series in the coming weeks and months, which is going to be really informative and useful. Anyone that's been already a student of mine is familiar with the concepts I'll be talking about, but it's still going to be a great refresher for those that have taken my courses already as well. It's not going to go as much into detail, but it'll be very informative and packed with a lot of useful tips that you can definitely implement into your trading strategies. So this video is going to be basically focused on time frames. We're just going to talk about some theory, and this is going to help us later on understand a lot of the analysis and top-down analysis that we're going to be doing in the future of videos. Okay, so let's just start off with some definitions. So what are time frames in trading? So to understand what time frames are, you can think of candlestick charts like matryoshka dolls. Basically, those are the dolls that you open one up, there's a smaller one in, you open another one, there's another one, etc. Meaning that when you're using, in this case, we're going to be talking specifically about time-based candlesticks. Every candle that you see can either be broken down into a smaller time frame or conglomerated, meaning putting all together with others to form higher time frames. So obviously, like if you have a weekly chart and you go down into a daily chart, and let's say you're in the futures market, well, you know that one weekly candle is going to equal 5 daily candles because markets are open 5 days a week. If you have a weekly chart in crypto and you go down to a daily chart, you're going to have 7 candles, etc. And we're going to see this pretty soon in the charts. Now you may ask, well, what is the purpose of looking at different time frames instead of focusing on a single chart, on one single time frame and just trading that single chart? Well, trends can be classified as primary, intermediate, and short term. But markets, like we mentioned, exist on various time frames simultaneously. So you can be trading the same market, but you can be focusing on an hourly chart. Someone else can be looking at a 1-minute chart, someone else at a daily, etc. And the market is basically moving on all time frames at all times. It just depends how you're breaking up all that information. Okay, so novice traders tend to focus only on one time frame to base their trading around, but they can be ignoring what the primary or higher time frame trend is, which can be making them take lower odd trades against it because they only focus on what their main execution time frame is showing them. Also, they can be trading the main trend, but then can be ignoring lower time frames that can help them refine entries or give them early clues that may be a change or pause in the primary trend. And if you follow any of the market analysis that I usually do on weekends, you can see that I always do what's called a triple screen analysis, meaning I'll start on the weekly chart, then I'll go down into a daily, then I go down into a 4-hour, then a 1-hour, etc. You know, you're basically breaking down the charts into smaller and smaller chunks, but you're always aware of the higher time frame levels and the trend, because that's really going to impact, you know, your trading decisions when you're going into the smaller time frames. So let's just see an example here. This is a Forex chart, US dollar daily. And if we focus on this candle right here, you can see we have the 4 parts of the chart. The high, which is the top of the wick, the low, the bottom of the wick, the open, in this case is a red candle, it's a bearish candle, so the open is the top of the body and the close is the bottom of the body. But now, how do we know what happened in this candle? If we look at this candle, we know this 4 pieces of information, which every candlestick chart is going to give us. However, we don't know how price moved inside of it. If I see this, I can assume it was something like this. You know, we opened at this level, probably we came down, we went up into the wick high, then we came down over here, we made the low right here, and then we probably just ranged, and then we finished up right here. Okay, so this is just an assumption. So the only way we can know what happened inside of this daily time frame is just to go on a lower time frame, and that's basically going to give us a breakdown of what happened inside. So now that same candle we saw before, we're in a 1-hour chart now, and we can see we had the open, market came down, reversed, made a new high here. We just basically wicked above this previous swing high, broke back down, so we made a swing failure or a fake out of this swing high. Then we went all the way down here, and then in the last hour we just had a small little retracement and we closed right over here. Okay, so you can see how by just changing the time frame and going from a daily to the 1-hour, now we broke that daily candlestick into 24-hour candlesticks, because the Forex market runs 24 hours a day, 5 days a week, and this gives you a lot more information. And if you break this down into a 5-minute chart, then obviously this 24 candles, you just multiply this by in this case it would be 5 minutes, so multiply that by 12, and then that's going to be a whole other set of more detailed candles that you're going to have. Okay, and then here we have a Bitcoin chart, and here we can compare how we have 3 different time frames. We have the 5-minute chart, which you can see we have 12 5-minute candles in 1 hour. Then if we go into a 15-minute chart, we have for the same period 4 15-minute candles here. And if we go into the hourly chart, we have 1 candle of 1 hour. So all these gray boxes are exactly the same as this. It's just showing us more detailed information on lower time frames. Okay, so now all this, what is the use, why is this useful? Well, because depending on what type of trader you are, there's many factors that are going to determine what type of trader, what type of trades you're going to take, such as how much time you have available to look at charts, how fast you can make trading decisions, your risk tolerance, what returns you're looking for, markets you want to trade, size of your account, etc. In general, we can classify traders into 3 broad categories, and each category is mainly going to focus on specific time frames. Okay, so if we're talking about day traders, this can be broken down into 2 categories. which is scalpers and day traders. Both of these traders share the same characteristic that, as the name implies, they will end up the day flat, meaning they do not hold any trades overnight into the next trading session. They just take their trades and they close and finish the day completely flat, either a win or a loss, but they're done for the day. The difference is scalpers are going to be looking at very low time frames. Scalpers are usually going to look for very quick, small moves of just a few ticks or a few pips with a larger position size, and they're just going to look to go in and out many times a day. So scalpers are usually going to be focusing on minutes or seconds charts. Usually they'll be looking at like a 5 minute, 1 minute, 10 seconds, etc. So very quick time frames. A day trader, they will usually, maybe they will look at a daily chart just to have a bias going into the session. But then, for example, for me, when I day trade futures, I'll use the 1 hour chart as my bigger high time frame to judge the trend. Then I'll use a 5 minute chart as my execution time frame to look for entries. And sometimes I will look at a 1 minute chart if I want to refine my entries even further. Then you have swing traders. They can hold trades from maybe a few days to even a few weeks at a time. And this type of trading works in any market. There's found all over. And so swing traders will usually look at weekly charts for the overall higher time frame. Then they will look at a daily chart as their main execution time frame. And sometimes, it varies, but sometimes they like to use 12-hour or 4-hour or even down to a 1 hour chart. And this is going to be to refine their entries. But usually swing traders place a lot of importance on the daily time frame as their sort of main signal. They like to see where the daily candles close, how that affects market structure, etc. And then the last category, just position traders or investors. They hold positions long-term, weeks, months at a time, maybe even years. So, position traders, they don't really need to actively monitor charts, but when they do, maybe they're going to look for a yearly chart, like 12 months, a quarterly, 3 months, or a 1 month chart, and maybe they're using the 1 week chart as like their entry signal, etc. Okay, so as you can see, the quicker that we open and close trades, the lower time frames you're going to pay attention to. Okay, so that's pretty much the main premise. Now, time frames help us to identify, like we said, trends, because ideally the most money is made when you can really latch on to a trend and just ride it out. So if you have a market that's on a very strong uptrend, obviously you want to get in on this. Ideally, you want to try to get in on pullbacks. You don't want to be chasing market when it's making new highs. And then you want to just let this ride until market, comes and breaks a structure that then may signal that there's a change of trend underway. So as we can see on this chart, this is a Forex chart, US dollar CAD weekly. We have a downtrend that has been going on for many months here. But if we focus now on a lower time frame, if we go into the daily chart, you can see that this whole period we were looking at on the weekly, if we focus on this circle right here, you can see that from the beginning of September until the beginning of October, for a whole month, the market had a strong rally up on this lower time frame. So as you can see, from a structure perspective, and I'm going to be making a video soon all based on market structure. This is mainly just talking about time frames, but it's very related to market structure. You can see this market is making lower highs and lower lows. So we are definitely in a clear downtrend. But that doesn't mean that, if you're an investor, then this is definitely a major downtrend. So maybe you're positioned short here for many months. But if you're a day trader or even a swing trader, over here in this period, there's a lot of opportunity in this month to go long, even though we're on an overall pullback on this main long time frame trend. And if we go down into the 1 hour chart, we can see this whole month that we had this trend up, and you can see all these opportunities. Each one of these sections is one trading day. So you can see, if you're a day trader, you're going to get a lot of really great opportunities to go long here. Some days are a little bit choppy to the side, but you can see how this whole month overall, this was definitely a month to try to go long. You were a lot more profitable if you were going long, because if you're, let's say, a day trader, you're not going to be focusing on this huge weekly downtrend. You're not going to be trying to just go short all the time just because the weekly down trend is down, because if you're a day trader or even a short-term swing trader, you're focusing on lower time frames. And this time frame, as you can see very clearly, we're just making higher lows. There's no reason to be shorting this market if you're trading, if you're day trading or swing trading, because the structure has clearly been to the upside. And then even over here, if you are a scalper, then even here on days like this, there's obviously now a micro trend within this trend. If you go on like a 5-minute time frame, there's obviously a lot of smaller downtrends on that time frame, etc. So you can see basically how, depending on what type of trader you are, we're going to be focusing on different time frames. And until that market structure on that time frame that we are executing on tells us otherwise, we are going to try to be going with that prevailing trend. Here's another example in gold weekly chart, a strong uptrend. But if we focus over here, we have two very bearish weeks over here. But in the overall context, this is basically a pullback. You can see this swing low was not broken. Structure is still to the upside. And so over here, this was a good opportunity if you're a swing trader to either add on to your position as long as this doesn't break below here, or as we're going to see now, if we go into the 1 hour chart, those 2 weeks of pullbacks are right here. So if you're a day trader, you had 9 days of continuous downtrend pretty much that you could have really, had a really nice swing trade to the downside, or you could have been day trading, downside targets, but always keeping in mind that if you zoom out, you are overall in a uptrend on the higher time frame. So you just got to be ready and pay very close attention to what happens when you're coming up into this previous support area right here. Okay, and if we go quickly just into trading view, just to pretty much the same concept we were talking about, like here we have a forex chart, Australian dollar, US dollar, and as you can see right here, we have a clear downtrend here, price making lower highs, lower lows. And this gray area that I have on the weekly, if we go into the daily, now instead of 1, 2, 3, 4, 5 weekly candles. Now we have 25 daily candles for the same period, and you can see how this retracement within this trend here to the downside, this retracement here gave us a lot of opportunities if you're a day trader or a swing trader to get long. Obviously, like if you see this, you know, like you made a lower low, lower high, now a lower low. So we are expecting a lower high. So we need to keep our expectations in check, in the sense that we know we're on an overall major downtrend. And so we can see there's a gap here. So I will probably mark this supply area, which we can see we barely missed here. Let me just clean up the drawings here. But, you know, I would pretty much mark off this supply area. We know that we've made a lower low now. So we are expecting now sort of a lower high in this area. Even though we can see here on the lower time frames, we did make a higher low and a higher high. But this is what I'm telling you, you know, if you're a swing trader, you got to pay attention to the weekly time frame, because this is telling you that until the market breaks above this previous swing high right here, the structure is still down. So if you're trading this on a daily time frame, like a swing trading, for example, you need to keep your expectations realistic if you're going long, and realize, okay, this area right here is probably going to bring us trouble right here, because this is the last supply area before this swing lower low, the lower high swing that we made right here. So you're expecting a lower high. And so, you know, from there, you just go into your time frames and you just execute here. If I go into a hourly chart, and let me just mark this off in the hourly time frame, and I go back, you can see right here, this whole gray box, and let me make this screen bigger. This whole gray box is that retracement on the weekly chart. And you can see how here, you know, I mean, if you're a day trader, you pretty much had from July 11th, when we started bottoming, until August 11th, pretty much around here, when we started topping here, you had a whole month of price like slowly grinding higher. So you had a lot of opportunities to either go with the uptrend on the hourly time frame, or the pullback in the daily or the weekly chart, let's say on the higher time frame. Okay, so anyway, pretty much I'm gonna keep the video there. I just wanted to touch up again on this concept of trading time frames, how we gotta focus on what type of trader we are, what kind of holding times we have for our trades, and based on that, what time frames we're going to be focusing on, and having a realistic expectation of what yield our trades can give us, and also what kind of entries and setups we're going to be looking for in that. Okay, so after this introduction, I'm going to be making soon a market structure introductory video where we're going to be talking a lot about time frames and price action, and how we can look for trade entries purely based on basic support resistance levels, pullbacks, and the swing highs and lows, etc. Okay, take care, have a good week, and I'll see you in the next video.